But I think we are getting a little too ESOP oriented. I think, sir, you have to bring a fresh perspective to this conversation.
I don't have much fresh. I tend to agree with many of you who have spoken about the initial investments were more into real estate, making sure you have a nice home to yourself. But all through my life, I have mainly invested into equities, barring this real estate investment that I've made. And the other deviation from equity has been a large, very large investment into a pension fund, which provides life cover also. In case something happens to me, there's enough and more for the family and post-retirement. So it kicks off when I turn 65. So that part is taken care of. So I don't have to worry about when I invest into equity, what will happen. And so far I've always been sort of single-mindedly, I've just kept investing. Means there have been cycles when some of those shares have gone down. I have not bothered to sort of exit. But if you look at the trend across last 15, 20 years, and if you see the horizon over the next another 10, 15 years, I don't see anywhere you can go wrong investing into equities in India at least. I won't say the same with some of the other global markets, but I'm a firm believer in the India story. So my advice will be whatever money you have, just keep investing into capital markets.
कौन से स्टॉक्स है वो भी बता दो भाई.
हाँ.
कौन से स्टॉक्स है वो भी बता दो. लगाना कहाँ पे वो बता दो.
No, so I will avoid some of the speculative, opportunistic, small mid-caps type of thing. There you can go wrong. But some of those companies where he has worked, Asian Paints, Marico, Bajaj, you just can't go wrong. Means if you were to look at a long-term horizon, whatever money you have, means I invest almost 70-80% of my income into equities, and it just does wonders. Just I can't think of any other better investment to make, to be honest. So once the real estate thing is taken care of, and this big pension thing has been taken care of, that's what I do.
I think the early days is finding your feet on what you want to do. So small starts in terms of SIPs, the usual mutual fund route where you may not want to do a specific stock. Just
See,
get
there are
the feel.
a lot of these things created by all these marketing folks in these mutual funds and all. They keep coming up with new schemes and this SIP and ye karo, wo karo. Just you are better off doing your own research and keep investing. Don't keep second guessing yourself.
Planning.
I think that's the mistake
Or
you
trying
make.
to time. There's a
You can
difference
never time
between
the market.
trading and investing.
Impossible to time the market. Don't keep second guessing. And if at all you have sold, don't again look back. Just move on. You made your money. Fine, you could have made a little bit more money. But if you start getting into that spiral, you will not enjoy this whole process of wealth creation, accumulation.
I would just like to add, I think one important takeaway, particularly for the younger audience here, certainly invest into an accident insurance policy, certainly invest in a good health insurance policy, not only for you, but for your parents and any other dependents. Even for your servants, I would say, or for your driver. Because at the end of the day, if that poor guy has a heart attack, he has no one else to look up to except you. So it's extremely important.
There are now some very good government pension schemes for your driver and all. You can.
And also, but life insurance, I've never been a fan, because while it's good to, the way to do that is very simple. You just have a term insurance. And you look at that, all right, I'm putting in this 5 lakh rupees. if everything is fine, it's good. If something is not right, then someone's going to get 10 or 15 crore if something goes wrong.
But
And
I
if
would
you're-
add there that a life insurance doesn't take care and doesn't pay you out in case of disability. So you actually might think about layering it up with an accident insurance.
Absolutely.
Because if there is permanent total disability, then life insurance won't pay you. And the only thing that pays
Whereas
you
medical insurance will.
no as in
Accident insurance will.
accident insurance will
Accident
pay for
insurance will,
for disability cover. So that's a. But since you spoke about pension, I wanted to get your views on NPS because I think that's a brilliant scheme, the National Pension Scheme, because it's up to 10 lakhs is exempt from tax at the point of investment. And if you create and they do a combination of equity, corporate debt, and government debt. And most NPS schemes over the last 10 years, CAGR, or not CAGR, but IRR over 10 years has been upwards of between 15 and 18%. And given that 60% of the corpus, 66% of the corpus can be withdrawn tax-free at the point of maturity, and only 1/3 is required to be retained for creating a pension stream. It's an instrument that is very, very underused today by individuals, as is Provident Fund.
So I've done it a bit differently. I've looked at once I retire, what sort of income do I need to have a very good life, to travel the world, to do whatever the thing. So and looked at that amount, and then said, get me a pension scheme which will pay me this money tax free, and on top of it, it gives me an insurance cover. That's added
100%.
bonus. I'm sure there will be other schemes which will give me variable type of returns based on the market performance and all that of the underlying funds. But I've looked at a guaranteed pension type of.
So as you get to be older, so let's say post 45, 50, that's easy to do because you've accumulated a corpus of money. NPS, the advantage is it's a salary deduction. You can start doing it from the time you're 25. From the day you start working.
It should be a drip that starts early.
Exactly. And it compounds over 30 years, which is
it's like
huge.
the PPF.
Yes. It can be small sums. It can start early. You can decide your allocation. It's doing what you would otherwise need to manually do, which you may not have the time and attention to be able to do. So it's doing your 25, 35, 40 for you.
I mean, look at it this way. If you get a 15% return, which is what most NPS schemes are delivering, money will double in 5 years. So if you put 1 lakh in year 1, in year 5 that's 2, in year 10 it's 4, in year 15 it's 8, year 20 is 16, year 25 is 32, and year 30, which is a proxy when you retire, you build 64 lakh corpus of your first year investment. And that's just the power of compounding.
Yeah. With tax efficiency. In
And
the
it's
early
hugely
years.
tax
So
efficient.
it's for the early years, it's extremely.